Should I incorporate?
Yeah, we hear this one a lot.
Hey everyone, it's Zen here, and on this month's episode of the podcast, I brought in Joe from Rethink CPA, who's a chartered accountant, to kind of talk about taxes, efficiencies, whether it should be incorporating, what you can write off as expense, because these are very common questions that I get a lot when investors ask me. I know the answer to some of them, but I thought I'd bring on an actual professional who's licensed in this field to kind of go over some of these things with you. In addition, Joe is also a mortgage broker, and he's also an investor. So he has a very holistic approach in the way he tackles accounting, mortgage, and how to optimize for getting the most investment property. So definitely worth a listen. Also, I didn't know, but Joe has a surprise at the end for everyone. So if you guys listen to the end, he does have a can't speak today. He does have a surprise offer for you. Okay, so make sure you listen all the way to the end, and hopefully this episode is helpful for you. Okay, enjoy.
Good day, Toronto. Welcome to another podcast with myself, Zen. We are joined by a good friend of mine who is an accountant that every real estate investor wants to talk to about taxes and saving taxes and corporations and everything. And on top of that, Joe from Rethink CPA is also a mortgage broker. So he has two of the pillars that are very important when it comes to real estate investing. One being mortgages and two being how to prevent your not prevent, but how to save money on taxes. So welcome, Joe. Thanks for coming on to the show.
Hey, thanks for having me here, Zen.
Yeah, for sure. I mean, I don't want to take up too much of your time because I know I'm going to have a gazillion questions for you and you may get bombarded by people because everyone's like, how do I save money on taxes? How to save money? So everyone always asks me, I'm like, hey man, don't ask me. I'm just not an accountant. You should ask Joe. So this is now we can ask Joe. The most common question I always get and why I wanted to bring you on was, should I incorporate?
Yeah, we hear this one a lot. Well, the short answer is it depends. Obviously, because you need to, your unique situation.
Yeah.
As everyone's different. But generally speaking, if one of the following applies to you, then you really should consider incorporating. Number one, if you have personal assets that you want to be protecting, away from being sued, then incorporating really works because it allows you to have a separate entity which protects those assets. Okay. Secondly, if you are at the highest personal tax bracket at 53.53%, which means that you're making over $220,000 annually, then you should definitely incorporate because you're saving on taxes. Inside a company, the passive income, which includes interest income, dividend income, and rental income, is being taxed at 50%. So you're saving 3%. Okay.
Yeah.
And lastly, if you have your own business already that you already incorporated, then you should also consider incorporating because you can then use the pre-personal tax money to invest rather than taking out the money from the corporation, being taxed personally, and then investing that money, which is a large chunk of it, right?
Yeah. So I understand a lot of what you just said. I think we should probably explain each point just a little bit more. Do you care to do that?
Okay.
So let me ask you. So first one, liability, right? So I think everyone knows this is just if, say, you own real estate investment properties, you have it in a corporation. If someone, say your tenant sues you, you're not legally liable, meaning that they can't come after you for your personal properties and assets, right?
Yes.
Yeah. So I think a lot of lawyers would also recommend that as well. The second one was the highest tax bracket. So why is that?
Okay. So basically, if you put the property inside a corporation, you're paying tax at 50%, no matter how much you're making inside a corporation. It's 50%, okay, for the rental income after expenses. But if you own it personally, let's say you already make over 220K, okay, you add that rental income into the mix, it'll be taxed at 53%.
Yes.
Meaning that you pay more tax personally than having the corporation.
Yeah. So basically, it's like you're paying tax at 53% if you make a lot of money over 220. And if you incorporate, the benefit is instead of being taxed at 53, you're saving that 3% and going to 50 because it's passive income, right?
Exactly.
Yeah. So like that adds up. And I think the third one that is my favorite and that we talked about many times before is using corporate money before personal tax to invest.
So, inside a corporation, let's say you have a small business corporation.
Yeah.
For small business corporations, the tax rate is really low. Right now it's about 12%.
12?
Okay.
Oh, okay. Slower than I
12%.
thought. I thought it was 13.
No, 15 used to be a few years ago. Now it's
Oh,
12,
okay.
including Ontario. So at 12%, you allows you to reinvest 88%
Mm-hmm.
of the funds, and you can use it towards buying a property or funding the property, right?
Yeah.
Instead of taking out money from the corporation and paying yourself, and then using those after personal tax funds to fund the property. Now that
Yeah.
saves you a lot, right? Because if you take out the money, depending on how much you take,
Yeah.
it could be close to 50% already.
Yeah. You're going to get taxed either way, right? So why not use that money for a down payment in the corp after you said 12%, right?
Yes. So that allows you to, well, eventually you have to pay the tax, but it allows you to defer it as long as possible.
Yeah. Yeah. Like, was it you or someone that told me it's like tax evasion is illegal, but tax avoidance is smart? Is it something like that?
I wouldn't call avoidance. I would say deferral.
Okay, deferral. Sorry. I don't.
Avoidance it's not a good word to use. CRA won't like that.
Okay, tax
Yeah.
deferral. And I think ultimately, from what you told me before too, is the corporation allows you to defer paying taxes so that you could reinvest faster, like you were just saying, right?
Yes.
Yeah. So I think this is a good kind of question to ask you now that we're talking about getting properties and why a lot of people may want to be speaking to you in the future because you have that mortgage background, right? So I've always told people like you have to be careful when you're in or buying a property under corporation because you qualify in a different manner. So how does that change from a mortgage perspective?
It depends on the lender. Okay, this is why we really have to, as an advisor, not just an accountant or a mortgage agent. I see myself
Yeah.
as an advisor where I look at all the different aspects together and come up with an approach.
Mm-hmm.
Okay, so depending on the lenders, they require different things. For example, one lender could be looking at your personal finances instead of looking at the corporation.
Mm-hmm.
Right? So there's a difference there. This is where I come in. Is I find the lender that makes sense.
Yep.
And in doing so, I also plan, the tax and the accounting to integrate with this decision so that the client will be able to obtain the mortgage that's required for the rental property.
Yeah. I think like a lot of the difficult things and like there's no way we can give anyone who's listening around a specific answer. It's just like you want to report a certain amount of taxes so that the banks will lend you a certain amount of money. But on the other hand of it, you want to defer as many taxes as possible so it's not coming out of you. And finding kind of like that middle sweet spot is kind of the magic that you're able to help people out with, right?
Exactly. That's exactly what I do, right?
Yeah.
The optimal point per se.
Yeah.
You take just enough so that you qualify the mortgage, but at the same time, you don't want to, pay, high taxes that is not necessary, right? So it depends on the situation. We look at, the whole picture in order to come up with that optimal point.
Mm-hmm. So are these lenders still doing, say, like 20% down payment, like 80 LTV?
Yes.
Okay. So that's really, really efficient then, right?
Yes. But not a lot of lenders do it, but there's certain ones that still do it.
Yeah.
And like I said earlier, the requirements are different for different lenders.
Yeah. Well, like I was just doing the math. Like you think about it, if say, okay, let's get a little bit mathy, but let's say you make $100,000 after tax. Let's just say it's 50,000 for easy accounting. Okay. You can use $50,000 of down payment, or if you have it in a corporation, then you can use 88% of that.
Yeah. So 88,000.
That's an extra $38,000 you could use towards investing, right?
Exactly. It's a lot faster,
Yeah, for sure. So like I think for a lot of people who are considering that, it's just you need to have the right approach in terms of how to acquire more properties, and especially have kind of like an integrated approach like Joe has, just so that you know the most you could write off, or sorry, not write off, like defer, so that you still qualify for the property moving forward, and just kind of like that optimal spot, right?
Mhm.
Yeah, yeah. Okay, no, that's good. That's very good. Like, I'm glad you said that, just because like every time you ask an accountant, they always give you a different answer, or it's always like it depends. Yeah, yeah. So thanks for that, Joe. Like one of the questions that I also get asked a lot, and hoping to get clarity is like, as like a real estate investor, what things can you write off?
Okay.
Yeah.
Once again, it depends. But the short answer is, short answer is anything that helps you make that rental income for the rental property. Yeah, interest, interest. Yeah, interest on mortgage, but not the portion on the principal. Only the interest portion is deductible.
The interest part. Oh yeah, yeah. So like between like, and you have a mortgage, you have the principal and the interest. The interest part is
Only
deductible.
the interest part is
Yeah,
deductible.
yeah, yeah.
Okay. Interest on HELOC, line of credit,
Yeah.
repairs and maintenance, insurance, advertising, utilities, condo fees, office expenses,
Yeah.
stuff like that, right? Did I say property taxes? Property taxes too.
No, yeah, and property taxes, yeah.
Yeah.
So like when you're analyzing, say, like investment property, and just so everyone knows, Joe's also an investor, so it's also why you should probably work with him. Like, what do you calculate cash flow net of expenses, or do you kind of build that in later?
So there are two numbers you should look at.
Yeah.
One is obviously cash flow, right, which all includes all the monies that you pay out in order to maintain a property,
Yeah.
right? So let's say, give a example. Your monthly rental income is, let's say, is $2,000.
Mm-hmm.
All your monies that are going out in order to maintain that property, which also includes the principal portion of the mortgage.
Yeah.
Let's say it's 2,000, so you're breaking even, right?
Mm-hmm.
Okay, so but you should also look at the other number, is the net income, which is the revenue minus the expenses. I guess the most obvious difference between the two numbers is the principal portion of the mortgage.
Yeah.
Okay, so if you are having a negative cash flow property, meaning that
It doesn't carry itself.
that doesn't carry. It doesn't mean that you're not making money. You could be still making money, on a net income basis.
But like, you don't get that like money in pocket until, I guess, you do your taxes, right?
Yes.
Yeah. Okay.
Yeah. So what I'm trying to say is, even though it's not cash flow positive, but down the road, it's doesn't mean that the property is losing money,
Yeah.
right? Because cash flow and profitability are two different things.
Yeah.
You are also banking on the appreciation over time. Right?
Yeah.
That's also not part of the calculation.
Yeah. Like one of the things I always I don't calculate is, but a lot of people should, is you don't always you don't, like, you always have to include how much the tenant is paying down the mortgage too, right? So like, I think on the first year of a $500,000 property, 30 years, it's like about $1,000 of like principal pay down each month, right?
Yeah.
So like that always adds up. So it really just depends on how people calculate cash flow. So I try to be very, very conservative and everything. I don't put a mortgage pay down, but it's good to hear that, like, sometimes it's fine still, right, to like break even.
Yes, so for sure. Nowadays, it's really difficult to find a property that's cash flow positive.
Yeah.
That you should shy away, from opportunities though, because like you mentioned earlier, you're still paying down the mortgage over time, and you're still banking on the appreciation, right?
Yeah. Well, like there's even some situations, and you can agree or not, like where if you're making too much income, even if it's under a corporation, isn't it better just have a nicer property that you can refinance and get money out of later, as opposed to, collect an extra few $100 in rent?
Oh yeah, for sure. Yeah.
Yeah. And I think that's kind of like the big thing, right? That we always like debate about it. It's just, do you want the cash flow because you need it for living or replacing income? Yeah, then you want that. But if you're working and you have a job you like and income you get, that you're happy and sustainable with, then how much cash flow you're really chasing down before you get taxed like crazy on it, right?
Well, it depends on how you look at it, right? So there basically two different components, right? Cash flow versus the appreciation over time, right?
Yeah.
If you have both, of course, that's great, right?
Yeah.
But if you have one or versus the other, it's still good, right?
So when it comes to kind of like writing things off, like how do you recommend like investors to kind of jot these things? Like any software you recommend, any tips? Just because you have to prove all these things at the end of the year, right?
Yes. So as CRA, they can go back to 7 years ago to check your records. So you
Yeah.
definitely want to keep everything organized.
Yeah.
Okay. So what I recommend is having separate bank accounts and credit cards from your personal side. Make sure that all your rental stuff, goes into one bank account. All the income that goes in it, all the expenses that you pay go into that account or credit card. Okay.
Yeah.
That way, there's a separation. In case the CRA comes after you, there's a clear trail. For example, if you have some personal expenses being used in that by that credit card, they could argue that, hey, how do I know which one is which? It could be all personal, right?
Yeah.
So definitely want that clear trail. In terms of software, I personally recommend QuickBooks Online because
QuickBooks. Yeah.
because it's cloud accounting. It's you can use it anywhere on any computers or even cell phones now. They have an app which allows you to take pictures of the receipts, and then it gets uploaded and converted into numbers. So that way, you don't have to do the actual, the bookkeeping part of it.
Inputting, right? Yeah. You're
Exactly.
telling me that's the system that you have, right? Like it plugs into what you have.
Yeah,
Okay.
I use it personally. Yeah, so and I definitely recommend it. I don't get paid by saying this, but I really like their system. That's all.
Yep.
And the fact that it's very non-accountant friendly, right? You can't
Yeah.
say that about the other software out there.
Got it. Got
Accountants
it.
know what's going on, but not non-accountants.
Yeah. Yeah. So QuickBooks, if you're listening, Joe needs a sponsorship. He's using your software. Yeah. Okay. So like record keeping, but what happens if like say it's like a mortgage bill or something like that? Like, do you scan it, take a photo of it? Because you have to split up the principal and the interest, right?
Yes. So for that, for mortgages, usually you get an annual mortgage statement
Mm-hmm.
from the lenders. So just use QuickBooks online to take a photo of it and just keep track of the amounts, the interest and the principal portion, which should be stated separately on the mortgage statement.
Yeah. Okay.
Yeah.
So if I'm hearing you correctly, it's basically open a separate account so that it's easier to trace. But should you open another credit card under like the same account?
I would if you're gonna be using a credit card to make certain payments, right? Let's say you go out and buy some furniture, then most of the time you want to use the credit card, right?
Yeah, yeah. So you could get some flyer miles, right? For when Corona ends, you can fly. Yeah. Okay. So I think one of the things that came up when we were talking like earlier this week was keeping the money separate. So let me pose a question because I get asked this a lot. If you have a line of credit, call it 100,000 on your home, and you wanted to use that $100,000 for investment, but there's also something else that you used it for, say maybe like a renovation on the personal home that's not expensible. Do you like how do you go about separating that? Like, would you open up another account so that it becomes trackable, or there's really nothing around it where you kind of have to pay off that portion before you have a very clean line of credit before you
Oh, I
invest?
see what you mean. Okay, I see what you mean. Yes. So if you can, I know some lenders allow you to have separate portions of the line of credit.
Yeah.
In that case, then it's a lot easier, right? Because you can keep track of which portion is for personal, which portion is for the rental property. Right?
Yeah, for sure.
Because that's tax deductible. If you can't do it, you could still just jot down the amount that you have taken for each side, for personal and for the rental property. Your accountant should be able to figure out the interest
I see.
on each portion. Right? It should be a very easy calculation.
Yeah. So you don't have to like open a separate like kind of account and
You don't
move
really
that.
have to.
Okay.
No. It just, there's more calculations to be done, but it's doable. It's not too bad.
Got it. Got it. Okay. So the follow up to that question is writing the line of credit interest off when you buy a pre-construction. So I know a lot of people say, oh, I can write the line of credit interest off, but I just discovered recently too when we were talking, you can only do it if it's producing income, and pre-construction isn't producing income. So what is the truth behind that? Or is what I'm saying true, or am I wrong? Because I know
No. So basically, you cannot deduct the interest, um, because, like you said, it's non-produce. It's not producing income yet.
yeah,
Okay.
okay.
So the right approach is to add that to the cost of the property. Let's say you bought it for $500,000.
Yeah.
And from the pre-con stage to the time when you close,
Yeah.
let's say you had $10,000 of interest that you
Yeah.
have paid. So you add the 10,000 to the cost of 500, which makes your property cost of 510.
I see.
And
I see.
you will be advertising it, with a capital cost allowance over time.
So is that what we were talking about? Like you're capitalizing it?
Capitalizing it. That's the right
Okay.
term.
Okay. I get it now.
So
I
you're
get
not
it
really
now.
deducting it as an interest.
Yeah.
You are capitalizing it.
Yeah. You're
That's
turning the interest into part of the cost of acquisition. So it becomes right off a bull.
Exactly. Yes.
But would you be writing it off on a per annum or only after you close it?
So the answer is it depends.
I
Once
see.
again,
Okay.
yes, because if like I mentioned before, if you claim capital cost allowance,
Yeah.
then you will be writing off, a little bit over time.
I see.
Year after year, right? But if you're not claiming CCA, which some people don't because they don't want what is called the recapture. Recapture is when you sell a property. There's two portions. There's capital gains and then there's recapture. Recapture is the amount that you sold the property for minus the amount that has been advertised down from a CCA.
Okay.
I don't know.
Okay. I get it. Yeah.
So yes, so some people don't claim it. So in that case, it will be treated as a capital gain when you eventually sell the property. So
I
you're
see.
looking at possibly a long time before you can actually deduct that interest.
Got it. Because if you claim the CCA, like too much of it, then when you sell it, and if and when you do, the recapture could be very high, right?
Yes, exactly.
So this is again also planning mortgages, talking with me, planning when you're going to sell, what the plan is, so that you're writing everything down. Yeah. Okay. Yeah. Okay. I get what you're talking about. If anyone is confused, it took me some time to figure out too. Just call Joe. It depends is really the real answer for it. Yeah. It really depends how you plan to use the property. So on that note, that like let's just say someone's buying a pre-con, right? And a lot of the times you and I both know that maybe they don't fully qualify for it yet, or they plan to increase their income. What do you think like you should report in terms of like being better to be mortgage qualified from like a tax perspective? So like, are you trying to, let me rephrase my question. Like, are you trying to increase your income so that you eventually qualify for the mortgage? Or do you try to kind of like write off more things so that you save more money, but maybe use like a different lender? Like what's the optimal thing to do in those situations?
This one's tough.
Is it also, it depends?
It depends. Yeah, that's why I don't know how to answer it per se, right?
Yeah. Because like I know some people like you try to report, like I did it, right? Like you report more taxes for a few years, right? Because we pulled out of the corporation and allows us to personally buy stuff on the personal name more, right?
Yeah.
Like, is that something that is advisable?
Yeah, I mean, well, yes, for sure, this is a yes, but I just don't know how to put the other way into the mix here.
Like as in like you don't know how to see if it makes sense to not report as much?
Yeah. That's why I don't know how to answer this question. You know what I mean?
Yeah, I see. Yeah. Because I guess it's hard to kind of plan for the lenders at the time of closing and what their requirements and conditions are, right?
Yeah, because from the moment where you put down a deposit versus when it's actually closing time, you could be looking at 3 or 4 years, right? A lot could change over that time, right?
Yeah, that's true. Given what we just went through, yeah, okay, yeah, I think that's a good answer. Okay, yeah. So we'll leave that up for chalking there. If you guys have like a specific kind of like scenario for you personally, we can't generalize. Just reach out to Joe. I'll put Joe's contacts in the show notes or like at the description for YouTube if you're watching it. Okay. So one of the things that I also wanted to run by you was like a lot of our clients, and this like they do refinance or use a line of credit to fund another property. So from like a tax effectiveness and a mortgage perspective, what is like a good strategy that you would recommend to be the most efficient?
Most efficient. Well, I'm sorry to say that the answer is it depends again. Yes, so it's very, I guess, situational. For example, you have to look at different aspects. For example, your your principal home mortgage.
Mm-hmm.
Is there what's the penalty looking like to break it? What if you
Yeah.
just enter into a 5-year fixed mortgage?
Yeah.
Then the cost would be very substantial. Then in that case, it's probably a lot better to go for a HELOC to fund the purchase, right?
Yeah. So that's going to like the same bank who has your mortgage to get the line of credit on it, right?
Yes, if that's possible. Right? Sometimes, if your lender doesn't have it, then you might have to go somewhere else
Yeah.
for it. That could become difficult depending on the amount that you want to get,
Yeah. Yeah.
right? And on the other hand, if you, like we were saying earlier, if you have a HELOC set up and it's and not for a big amount, that you need for the rental property, then you should do that, right?
Mm-hmm.
Especially when you know that you can repay that amount soon.
Got it. Got it. So if you had that option, like say you have a home and you have some equity in it, there's no crazy fixed penalty. Is it better to refinance to fund your rental or to use it as a line of credit to fund
I
your
would
rental?
say it's better to refinance because most of the time the mortgage rate is lower than the line of credit rate.
So that refinance like outstrips any kind or like most of the or the refinance will get you more benefit than say even writing off the HELOC only interest for
Yeah.
funding. Got it. Got it. Okay. And is this like particular to this current situation now where like, we're getting mortgage rates of 5-year variable like under 2% or like generally that's the
I
case?
mean, generally speaking, line of credit rates are usually higher than mortgage rates.
Got it. Got it. Got it. Okay, no, that's very helpful. I think a lot of people ask these questions and like how to fund it. So if you guys are kind of looking on how to structure a corporation, how to get the best tax efficiencies, right? That's the correct term, and like also get the mortgage help. I think you should reach out to Joe. Actually, one of the things I was going to ask you, like, you can also help other clients incorporate, right?
Oh yeah, for sure. Yeah.
Yeah, so it's like a all in one stop, right? That's why we like referring people to you.
Mm-hmm.
Yeah, for sure. Awesome, man. I appreciate your time. I won't take up too much. I did have one final question that I was going to ask you is
Yeah.
from an accounting side, because I know a lot of people try to like get specific tax advice, but it's very difficult for anyone to actually provide it because, like you said, it depends. And I appreciate you being more specific than most accountants. I do appreciate you letting people know about that. But like, what do you think is the most important thing for when people are picking an accountant?
I would think that you should go with an accountant that looks at the whole picture.
Yeah.
For example, let's say a client has their own business. The accountant shouldn't just look at the finances of the company. They should also look at their personal finances, what their short-term goals are, what their long-term goals are, and try to incorporate everything together.
Mm-hmm.
This is also a moving target as well. Because as you know, circumstances in life change, and when
Yes.
that happens, you have to realign, the tax strategy in order to reach the short-term goals or the long-term goals.
Yeah, for sure. So you're saying basically get an accountant who has a more holistic approach to things, right?
Exactly.
Yeah.
Exactly.
Yeah, I've made that mistake before when I was younger too, not having a good accountant.
Yeah, because any accountant can run the numbers, right? That's the
Yeah.
easy part. I think where it's more valuable is to plan ahead, and such that you're prepared as to what's to come in the future.
Yeah, I completely agree with you. It's just because, like, I always say a good accountant will be worth every dollar that you pay them because they'll make you tax efficient. And then when you kind of also line it up with like your ability for like getting mortgages, lining up so that you're optimal for mortgage versus taxes, kind of like that balance between the two and tax strategy, it's a very good approach to doing things. So like I think you may have a lot of people reaching out to you that are real estate investors. So I do appreciate your time, Joe. Before we sign off, is there anything you want to add that I'm going to ask you that you want to tell people, or anything that's like, the current times related?
Sure. So if you have any questions, anything that's accounting, tax, or even mortgage related, feel free to reach out. We provide 30-minute free consultation.
Ooh, you are going to get bombarded, sir. You are going to get bombarded.
Yeah. So because everyone's situation is different, so it's really hard to give general advice. But we do recommend people who are interested in using us to plan to reach out to us.
Yeah. All right. If you guys are listening to this is going to be a lineup. I don't think Joe has that much time. I know he's busy. So if you want to get your 30-minute consultation before he gets fed up of giving up free tax advice, you should book him now. No, I'm serious. I'm really serious. Like very rarely do accountants would give out their time like that. So I appreciate you doing that for our listeners, Joe. Much thanks. Awesome, man. Appreciate your time. And if I'll put your contacts for people who want to reach out to you for a free consultation in the link below. If you're listening on the podcast, it'll be in the show notes. If you're on YouTube, it'll be in the description. Okay. Thanks again for your time, Joe. Appreciate it. Take care.
Then take care. Bye now.
Bye now.
Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.